I think, Rob, are you in the Bay Area? Are you in Nevada? Where are you?
I'm in the Bay Area.
Mill Valley, that's my home.
That's right.
I bet, uh, I bet no one on this call tuning in will remember that song from about 1969 or something.
Yeah. I would sing it to you, but my voice just wouldn't fit the seriousness of this call.
No, it would be, it would be interesting. So we'll get to mortgages here in a second, but back in about was it somewhere in the late 60s, early 70s, there was a grade school in Mill Valley, and the teacher wrote a song, Mill Valley, that's my home, and it kind of swept through the nation in a minor kind of way. It would be interesting to go and track down the kids who were on that song and see what's become of them.
If they're living in Mill Valley, if they can afford a home in the Bay Area.
Yeah, exactly. From the royalties from that song. All right. Well, everybody, welcome to the show. We've got a lot to talk about. Some of it may even be capital markets related. We've got 44 minutes now to talk about some of these issues, and it's been a interesting 3 weeks. Is that how long? Let's see, January 20th, when the inauguration was, and one can argue that some of it has had a direct impact on capital markets and hedging a pipeline. And some can argue that some of the other things uh, may not or will not. And so I think even though this is a capital markets call, I think the fact of the matter is the CFPB, which has been a big question mark for some time now, and what happened over the weekend, which was basically the acting director shutting it down, is a big issue out there, even though it doesn't impact interest rates at all. James, I wanted to get your thoughts, given that you're closest to Washington, D.C. right now, being in Baltimore, Maryland. What impact, what of the questions that you've been fielding, what have they been? What are originators asking right now? And what have you been answering?
Yeah, it's a great question. I mean, I think like a lot of things coming the last few weeks, it certainly is a complex issue. And part of what we've all been kind of working through is, trying to figure out everything and trying to learn as much as all that we can. With respect to the CFPB, I mean, certainly there's lots of opinions on all sides about their efficacy and their role and the state of regulation in general in the industry. I think the thing that we've been really talking about the most, kind of wondering, and perhaps a good topic for this group is, I think it's tempting for lenders to perhaps breathe a sigh of relief and say, all right, finally, compliance costs and legal costs are going to, maybe decline and so on. But, in our view, the question becomes, what does this do perhaps to regulation at the state level? We've seen before, certainly some states are more aggressive than others in terms of regulating at the state level. Does this news maybe empower them to take things a different direction or to a different level? Do some less aggressive states perhaps change their thinking? So said another way, if you're in compliance or regulation and you're, generally believe in the CFPB's mission, what do you end up doing to that for the state level? So I think about that from the perspective as well, from maybe of a larger lender, let's say even a national lender, that instead of having one centralized entity to take the lead on some of these matters, do you ultimately have a variety of standards or perspectives? So don't get me wrong, I'm not trying to pound the table and defend the CFPB, but I do think that at the same time, lenders who are expecting a sea change in the regulatory environment and a lot less of these types of calls may be ahead of themselves. I think they'll just kind of be different.
Yeah, I would. I actually talked to some folks from Poly about this, and thank you for Poly to Poly for sponsoring the show here. Very much appreciated. And Poly and when you talk about pricing, it's relatively easy on a relative basis factor in, different servicing values or different values for different states and so forth because of foreclosure laws, whatever it might be. But when you talk about compliance and regulatory issues, when you're talking about state level, it really gets complicated in a hurry because if you're a multi-state lender, to your point, James, um, you don't want to be dealing with 50 little mini CFPBs. And many states, for example, California or New York, Illinois, they don't have just one regulator. You've got two or three regulators sometimes dealing with lenders, especially if you're a bank with a mortgage division or a credit union with a mortgage division. It gets complicated. So Ira, you're also dealing with originators. Where are their concerns, if any, or are they just kind of saying, at some point we're going to, Ira will see us through this?
Yeah, I mean, I agree with a lot of what James said. I think the initial thought is everyone was sort of excited, oh, thank God we no longer have to deal with CFPB, but the grass isn't always greener. We're in 48 states. Just dealing with the audits from these individual states is enough of a headache. It's tough to imagine dealing with all these state rules if you don't have a central CFPB. And I think some of the concern, and James mentioned this, is companies doing things that are not legal because they think that there is no longer any enforcement. And, that remains to be seen. One quick warning with that is just because the CFPB may not exist in the next year or so, doesn't mean that we won't see additional organizations years down the road. And those organizations may look back at activities that are done now. So you don't want to, pay for anything done wrong now, 5 years down the line if something was to change. So just because, the CFPB may not exist, it doesn't give everyone sort of a ticket to just do anything they want. They eventually will pay for those fouls.
So, Rob, I made a joke today in my subject line and then my opening paragraph about, uh, what did I say? Ability to repay or state income, state asset loans coming back. And then I said, just kidding. Um, you have the unique perspective in with the academy dealing with a multitude of capital markets and secondary marketing people and so forth. Have you been fielding questions from them about this? Are you going to incorporate the CFPB's potential changes in your curriculum this semester?
Well, I think there's a big question about what actually is going to happen. I mean, as I understand, it's created in a statutory sense, and shutting it down. And there's all these challenges going on with what's going on with a bunch of the administration's changes and stops of work and stops of funding that are going to get litigated out, ultimately state and maybe Supreme Court level. But I think just by how the CFPB was created, I'm not sure that it's going away or can go away without congressional action. So I think at least it's a question mark as to what happens with that. There's certainly a lot of the politicians that support that institution. So I want, already counted out and gone. Certainly, to James's point, many of these things exist on the state level. State regulation remains, solidly embedded in the mortgage lending process. That's not going to change anytime soon. So the short answer is no, not a lot of calls. I think there's a lot of wait and see. I think another thing I'd add to James' earlier point, anyone dealing and lending in multiple states, they're trying to figure out scale. They're trying to do things in a consistent manner so that they can, basically try and lower their cost structure, realize as much as their profit margin as possible. And so I think it's wait and see and, look for how they continue to implement economies of scale.
Yeah, a good answer. I've been telling people that, especially when it comes to the ability to repay, which is monitored by the CFPB, there's a reason that was implemented, so that we didn't have state income, state asset loans, or people exaggerating their incomes. And in the secondary market, that information gives investors in mortgages, whether they're going into portfolio or whether they're going into a mortgage-backed security, that the ability to repay gives those investors comfort that that borrower is going to make their payments. And when you talk to capital markets folks and investors, they will say, they are dealing with a book of business that's out there, existing MBS and so forth, where, it's the cleanest ever underwritten, has, the best ability to repay, the most equity. I mean, now is a great time to be an investor in a mortgage-backed security. And I think that, of course, anything, a certain price, certain rate, you can sell something in the secondary market. But if you have a situation where there's questions in investors' minds about the ability to repay, or was this loan done in a compliant manner, and maybe compliant in Utah may not be compliant in Florida, may not be compliant in New York. How is a money manager in Japan who's buying, 500 million of these at a time really going to be able to monitor that? It's a yeah, it's a sticky wicket, as they say in Bermuda. Uh, James, the has the market, have you seen the market be volatile in terms of reacting to some of the news that comes out of the Trump administration? And I'm switching gears here to talk about the tariffs, which on again, off again, on again, off again, partially on, partially off. I mean, do, are investors in the MBS market, are prices just shrugging that off, or are you having trouble hedging based on the news stream?
Well, certainly the news is coming fast and furious. There's no denying that, and we're getting a lot of updates intraday and so on. I think what's been very interesting so far is the answer to your question, at least for me, is that it kind of depends. The first round of tariffs, I believe, came out over a weekend, and the markets, both the bond market and the stock market, had pretty substantial volatility. But then intraday, the tariffs on Mexico, the tariffs on Canada were reversed. And so we saw a similar reaction in the market too. So plenty of market volatility, but we generally ended, I believe, right around where we started. But then fast forward, the latest round of tariffs were the 25% tariffs, I believe, on steel and aluminum just recently. And what was interesting to me, kind of to your point, is the market so far seems to have kind of shrugged and moved on. So it seems to me that the market is still trying to get a handle on what the playbook looks like. But if today's reaction is any, or excuse me, the recent reaction is any indication, it seems like now we're moving into more of a wait and see kind of approach, as opposed to, oh, here comes the tariffs. Well, we know exactly what to do. We have market volatility. This is bad, perhaps, right? And now it seems to be more like, that's interesting. The first round was a negotiating tool, perhaps, and let's actually see what ultimately gets impacted. So certainly we're paying more attention to the news throughout the day than perhaps we were 3 months ago. I think that's very fair to say. And we're seeing some volatility as a result of it. But I think it's also depending on what the news is, and we're in a wait and see kind of mode.
Ira, are you telling, let's say, we could role play, and I could be a loan officer calling you up and asking you the usual, gee, should I lock now? Tariffs are inflationary, so that means inflation's gonna go up, which means the Fed isn't going to cut. In fact, they may raise rates, blah, blah, blah. What do you tell originators in this kind of environment?
Yeah, so far the news, as James said, if we look back at the last month and a half, we've been in a fairly tight range of rates. They haven't moved that much. So that being said, the potential for volatility is there, and that's what I try and tell my staff is, just be mindful of the risks. Even though we've been in this somewhat steady 10 basis point range of rates for the last, month and a half, that doesn't mean that, a sudden action here or there can't change that either way. So it's really being aware of the risks versus a day-to-day, lock float decision. Obviously we have the major economic indicators, jobs reports, inflation data. And those are the points that you want to be careful if you're floating into those events because they have the potential, obviously, to move markets. As James said, the tariff talk lately has not moved much, and I don't know if that'll continue, but it's really being aware of the potential for movement. And if it doesn't move it, great. But if it does, you at least want to be prepared, and preparing your borrowers for those risks.
I think that's such a good point. If I could just jump in, I think understanding the inputs is always critical, but especially right now, understanding that just look, we have a lot of moving parts. We're just getting started with this, and there's a lot of things floating around out there. You said it very well there, Ira. In the conversation of explaining to a borrower what's going on, the conversation, in my view, is a lot of, hey, these are the kinds of things that are happening, could happen, and so on. Just understand, make your decision for yourself if you, for example, lock or float. But understand that we have more volatility than we previously did. And so I think it's just explaining that this is the time and market that we're in. This is the world that we're in right now. And look, there might be some opportunity. There might be some short-term kind of volatility. Maybe that even goes in your favor, but understand the potential for downside here too. So I think it's just understanding the inputs so that people can make a better, more educated decision.
Yeah, we've got a couple chats here, which I'm just don't shoot the messenger, but how do you manage your compliance risk for the environment we might have in 4 years or in the next 4 years? And then somebody wrote in, it doesn't matter the lawsuits that are brought to stop this. Even if the judges rule in favor of stopping this takeover, there's no one to enforce the judge's orders. We know the DOJ will not step forward. So I will open my kimono here a little bit, Rob, and say, I've become like this lightning rod of political emails, and I have a clip of one of my emails in tomorrow's opening paragraph, but we've gone from kind of the Biden administration where it's been relatively benign, sedate, whatever you want to call it, predictable. Everybody was wondering what the Fed is going to do next. And now we're in this environment where compliance and interest rates are, no one knows what's going to happen next. And it doesn't take long to flash back to Trump 1, the previous administration, where some tweet would go out in the middle of the night and the bond market or the stock market would, jump. What advice are you giving, if any? We heard from Ira, we heard from James, but I wanted to give your input because you have, as much experience as those two combined. No, I'm just kidding about that. But what do you tell folks? I mean, steady hand on the tiller, we'll get through this. It doesn't matter. I mean, what are you telling folks?
On the regulatory side, just sit still and continue business as is, and let's see how this shakes out. And I mean, there are things that, as an industry, that hopefully we'd make some improvements on with respect to regulation. And I don't think it's exactly the getting rid of CFPB, but there's disparate impact. There's other parts that could be much better for the industry to create more certainty. And obviously, from a policy point of view, more certainty in our industry ultimately brings more people in. It drives down the cost of home ownership, which is what we want from a policy point of view. So it's just sit tight and see how things play out. There's so much in play right now. And on the interest rate side, which is the tariff conversation, the inflation conversation, I mean, there is literally so many things in play right now about everything that's going on with some of the audits, Doge, and other things. Even what the recent employment prints have been. There's just it's not any clear picture on where things are going. And so I'd go back to what both Ira and James said. My advice to an LLO would be, what are you trying to gain by not locking? I mean, if you're going to close the deal, lock it in. This is a high period of uncertainty. I don't think the juice is worth the squeeze waiting out on that, and just muddle through this until some direction shows up.
So I remember and I don't know who's on this call. I inevitably get in trouble for things I say. But, during the peak of, 2020, 2021, which is now 5 years ago, the loan originators had so many loans in their pipeline that it really mattered lock float. They had huge blocks of loans that they would lock or they wouldn't lock, and you could tell when somebody might be out there predicting interest rates were going to go up or go down tomorrow, and you should lock accordingly. And you know Rob, as you know, on the trading desk, I mean, we used to keep a coin, and if I had an originator or somebody say, "Should I lock or not?" and I'd flip a coin, heads lock, tails don't lock. Half the time you're right, half the time you're wrong. Really can't predict these things, but it really now I would say that every loan is so precious that uh, you know the loan officers that I talk to are decent at what they do. They tend to lock as soon as they have a viable loan, and it takes the uncertainty out of the way, off the table, and let's work on your loan, and let's, get it through. And we don't know what's going to happen with interest rates. We don't know what's going to happen with compliance and regulations. Let's just lock the loan, and that's for sure. Let's move on from there. So that's what I'm kind of hearing out there. But speaking of every loan being precious, the the shift in the market has been interesting as the years have gone by here. With, I used to run a subprime company, so I know subprime to some extent. And then 2008, 2010, all that went away. We had Dodd-Frank, we had the CFPB, we had QM, non-QM, and the QM business has been doing this. And I think, given that you never want to tell a borrower, I can't help you. No, we don't have that program. Nearly every company out there has some kind of non-QM or portfolio product that they are able to offer their client, whether that's some kind of bank statement loan, DSCR, whatever it is. And I heard an interview today with the head of sales for Logan, who he threw out a figure of, let's say we do $2 trillion this year. There are estimates out there that show that non-QM loans will account for, maybe it's more non-agency loans, which is probably more reasonable, account to 10 to 15% of that 200 or 2 trillion. Okay. So let's just say 10%. So that's 200 billion of non-agency loans, which if you get your calculator out and divide that by 12, you end up with, let's just call it 100 billion a month of non-agency originations. James, are you seeing that kind of, I won't call it a tidal wave, but it's definitely a change in, change in business mix. Are you seeing that with originators right now?
Yeah, we're seeing more momentum to it. And I think I want to go back to something you just said, I think is so critical, which is from a lender's point of view, you want the ability to say yes. You want the ability, if you have a borrower, to say, yes, we can close the loan. Now let's talk about the best strategy for you, as opposed to saying no. And I think non-QM in particular gets a bad rap as we talk compliance and as we talk regulation. There's still quite a few folks, perhaps even a majority, I would speculate, of the industry that thinks that non-QM is basically the new subprime, is the new Alt-A, is the new, it must be something there. And I think part of it, as an aside, is really the name of it. Very few things are defined by what they're not. Non-QM, you don't go to a restaurant and order the not steak, you order the chicken, right? So I think that's part of it.
Good point.
But I think demystifying non-QM continues to be a topic of conversation. When you're talking about a bank statement loan, you're simply talking about a self-employed borrower. When you're talking about a DSCR loan, you're talking about investment properties and a different way to value them or approve the credit. So yes, it is something that I think is going to continue to pick up momentum. It's conversations, internally we continue to have about how can we continue to go into that space. Because again, at the end of the day, it's sitting down with a borrower and giving them a wide range of options and saying, here's what we can do. What's the best situation for you? So it just incrementally, in my view, allows lenders to continue to say yes. And I think once you get through the demystification process, that helps greatly.
I like that. You don't typically define something by something it's not.
Right.
Ira, what has the investor landscape for non-QM or not agency products expanded over the last year or two, or has it been relatively stable?
Yeah, I definitely think it's expanded. We've seen our non-QM business increase, and I definitely believe those numbers that you mentioned earlier. The other piece of that business, if you look at the credit profile of the majority of these borrowers, they are super strong FICO scores. They are strong borrowers. So we're not talking about, as James mentioned, the the thought process of these being, subprime borrowers. These are strong borrowers, strong credit profiles, and it's just a loan that does not fit the agency, credit box. It's that simple. And it's nice to see an option where you do have the availability to still do those loans. Obviously, the rates may be a little higher, but you're not talking outrageous rates. And especially borrowers that may want cash instead of taking cash advancements at outrageous rates. It definitely, allows them the ability to accomplish their goals. So I think, we've seen the investor landscape increase. It seems like another new investors sending out emails almost every week with a new product, a new offshoot of their QM business. And I think we'll continue to see that increase as well.
I'm glad you brought up the credit box piece as well, because that's another piece of this consideration. It's also the agency LLPA matrices. There are some loans that, good, bad, otherwise, the way that Fannie and Freddie have structured their upfront credit fees, that are pretty punitive, especially if you look at investment properties, second homes, cash out refinances, and so on. In a lot of ways, kind of big picture for our industry, we should be excited about this, where you have a non-agency buyer who looks at looks at a loan scenario and says, you know what, I'll take that. I'll take this risk. It's a 70 LTV investment property. I feel pretty good about that, and I can pay a premium for it too. So I think the other piece, as we differentiate between what Rob mentioned, non-QM versus non-agency as well, is that sometimes it's just simply a buyer who likes the return profile and thinks that they can be comfortable with the credit risk and can buy it at a higher price. So I think, certainly from a lender's perspective, it's all about achieving best execution as always. And I think that just having a full suite of investors is just more optionality for you.
Yeah. So, Mr. Kessel, you've sailed your hedging craft through, rough seas, through placid lakes. You've hedged pipelines through fixed rate markets and ARM markets and subprime markets and so forth. What advice would you give? Let's say somebody who's on the call here who is running secondary marketing or capital markets for a smaller mid-sized lender, who is thinking about hedging non-QM locks or jumbo locks. And the second follow-up question I would ask you is, how would you explain the investors out there their hedging philosophy? I know Polly does a good job in terms of being able to price these loans, and once again, thank you to Polly for sponsoring this. But product and pricing engines out there do a good job of pricing it. But how would you think, without you sharing any secrets that you might know about, how do the Deep Havens, the Logans, the E-Resis, how are they hedging the production that they're seeing from originators? So the first part is, would you advise hedging jumbo or non-QM to a smaller mid-sized shop? And if not, what can you explain about how the big investors are hedging those locks?
So, it's a pretty consistent formula as far as, do I have a mandatory takeout is like the first question that lenders have to ask themselves before they figure out if they're going to hedge or not. And that these are, of course, mid-size and smallers. They don't have enough for their own securitization shelf themselves, right? And so it's always like in standard secondary, who are my investors? What's the best price? And so in that constant search, identifying where are their mandatory programs, where are their bulk bid tape type programs that might create a mandatory best effort spread that's worth it. And so first rule is always staying on top of those options. And then for those that are contemplating maybe if there is a mandatory program that emerges, they're always trying to hedge and offset what price change the buyer is going to experience. So they kind of have to replicate on their side what the buyers is going to have to do themselves as far as hedging the interest rate risk. And that's non-trivial, right? Like if we just think about non-QM, it comes down to how the credit rating agencies are gonna separate the product with credit enhancement, and it's what length of maturity the type of instruments and bonds underlying the issuance are going to be that are ultimately issued, what instruments can hedge those. And so generally speaking, it's non-trivial, and in our terms of secondary, there's tons of basis risk. And obviously the deep havens and others that are securitizing understand this very well, and they take on that risk and they have to feed that through in their pricing. But and those I don't know, in my opinion, if we've actually recovered from 2008 with respect to bond ratings. I think that there's probably inherent conservatism in there and just how all those bonds are rated, and that that of course drives price down on the total issuance. So generally speaking, those are the kind of things that you'd look at, and it's a lot of devil in the details depending upon the product set they're buying and how that's rated. That would determine what gets hedged and what opportunities are out there.
Yeah, it's always been a Fannie Freddie, FHA, VA, relatively straightforward. And then you get into jumbo and ARM. And I still hear, I shouldn't say still, a lot of people out there remember, I think it was March of 2023, when the non-QM investors bailed, right? Or was it 2020? I don't know. I'm losing track of my years, but sometime, they backed out of the market. And if you had a pipeline that was locked with a particular investor, and that investor said, we're going to sit on the sidelines here, that hurts if you're an originator, if you're a lender. And that memory is still present out there, that unlike government products and or the implicit guarantees of Fannie Mae and Freddie Mac enjoy, non-QM or non-agency investors can just say, what, we're going to price ourselves out of the market, or we're not, going to buy any loans or whatever it might be. The thinking out there is that they are held to a different standard, or I should say that, Fannie, Freddie, FHA, VA, Ginnie Mae are held to a higher standard, and they're going to be around, whereas an investor might not be. So that memory is still out there. James or Ira, anything you want to add to this part of the discussion?
I was just going to add to that last piece there. I think a really critical thing that we are talking about is the general idea that conforming conventional and government loans are broadly homogenous. That's the agency wrapper that gets put on them means that, yes, certainly as a secondary professional, we have the risk that investor A pulls back and we have to sell to investor B. But what you're getting at, Rob, is the investor is gone and there's no place for that loan. And it's perhaps a bespoke or custom program that you have originated to. And when we talk about the hedging proposition, especially if we're aggregating and holding in bulk, that can be kind of an existential conversation for a lender. I think Rob articulated the risks pretty well, that when we talk about selling into the secondary market, or when we talk about perhaps being one of the big guys that is securitizing, that's a challenge too. Sometimes the securitization market really does freeze up, and you might think that you're originating to X spread, and it turns out to be Y spread, and that's a material problem. So, yeah, I would just underscore a lot of that. That it is certainly a significant decision. It's something that smaller lenders, mid-sized lenders, even large lenders shouldn't enter into lightly, and that, as Rob was mentioning, the deep havens of the world and the larger players of the world, that's all they eat, sleep, and breathe all day. And so it certainly shouldn't be a side gig, for lack of a better phrase.
And
Yeah, it's not.
just to jump
Oh, go
onto
on.
that as well, from our side, if we were to even see any sort of major economic event occur that even could affect the liquidity of non-QM loans, we would be in a better position to just say, okay, you know what, let's shut it off internally. Let the waters calm down and see how things play out. Lessons learned from it was 2020. By the way, Rob.
Ira, when you get to my age, you have to double like everything. If you think something happened 2 years ago, it happened 4 years ago. If you think something happened 5 years ago, it happened 10 years ago. So I don't remember what I had for lunch yesterday, but I remember like the order of songs on an album from 30 years ago. It's really 40 years ago. Anyway, the mind is an interesting place. It also this conversation reminded me of the turmoil that the agencies cause. Shifting back to the agencies, Fannie Mae and Freddie Mac. Oh, it's Tuesday, so let's change our G fee. Boom, and that's a risk that you can't hedge against, right? So you don't want to see that in the non-QM world. Ira, I might be pushing the boundaries of your tenure in the industry, but back in 16, 18 years ago, you could call up Lehman Brothers or Solomon Brothers or Smith Barney or whoever, whatever investment bank you chose, and say, hey, we have an interest from our originators in this kind of product. Would you be interested in buying, X amount underwritten to these guidelines? Are you ever approached, once again, without you offering up any secret sauce or any company secrets? Have you been approached, or do you hear about that coming back at all? That kind of secondary market environment?
I personally have not heard, but I did experience some of that back in the day. Sort of tailoring our own guidelines and having them approved by like a Nomura or Winter or one of those. But it's not something I've heard of lately outside of maybe some arrangement with the Fannie Freddie, maybe a special purpose credit program or something of that nature.
All right, interesting. Rob, were you going to say something?
No, I mean, I was just thinking, there's always a warehouse bank component to it too, right? Because whatever programs they're agreeing to fund, they've been burned as well, right? And so just ensuring that they don't have a disappearing takeout for lenders is because, as many IMBs especially are highly leveraged, and any high degree of buybacks or unsellable loans on the balance sheet can be existential. And so, obviously they're a key part of that decision-making process in this whole proposition.
So I know we only have about 5 minutes left, and totally a different topic here because, Rob, you mentioned warehouse banks, and I'll throw this open to the three of you. A year or two ago, or back in the old days, warehouse banks expected a certain performance, certain profitability, certain this, certain that from their clients. And if you weren't profitable or you weren't adhering to whatever covenants, restrictions, and so forth that you had agreed to with your warehouse lender, the warehouse lender could or would cut you off and say, well, you're not profitable, so we're not going to do business with you anymore. We don't see you as a good credit risk. And then we got into a period of time where quarter after quarter seemed like a lot of lenders were not making money, which in theory put them in violation of their agreements with warehouse banks. But I never really heard of any warehouse banks cutting off anybody. And then fast forward to, last quarter, the quarter before that, seemed like a lot of companies turned a corner, turned a profit. What do warehouse banks still expect companies to make money? Or if you have a plan, then they're good enough with they're fine with a plan to make money? Ira, James, I mean, once again, without stealing any secrets, I mean, what's going on with warehouse banks these days?
From what we said, sorry, go ahead.
You get started.
Yeah, you sort of mentioned it, is having a plan, being proactive. Listen, the warehouse banks, they talk to, how many lenders, they know what's going on in the industry, but showing them that you're aware of losses, you have a plan going forward, and showing them that, you're proactive in implementing a way to make changes and reverse any losses. They understand the dynamic. If you're outside of the norm in the industry, that's a different conversation. But if they're seeing the same thing from similar, lenders, they just want to know that you have a way and a method of correcting it going forward.
Yeah, I would agree with that. And, we've been in a fortunate position that we've been not had too many of those uncomfortable conversations or anything to that effect over this cycle. But the conversations we have had with warehouses is they've made the point, some of our bankers, that when we ask a similar question, Rob, is, when you make the decision to cut someone off, if you're a warehouse banker, that's a pretty big deal, obviously. And so it's not something they do lightly. It's not something that they do without a lot of consideration. And I think if a warehouse rep was on here, or anyone that worked on the warehouse side, what they would say is, look, it is a partnership. We understand that there's cyclicality to the business. We understand that there's going to be good times and bad. And I think Ira said it very well, is that they want to see that you're aware of your business, that you're aware of where the pain points are, and that you have a plan. So I think that's when we have this, when I talk to colleagues or friends that work in warehouse, that generally is their perspective. And to your point, Rob, it's a little bit striking that covenants seem to be less important or less enforced than they used to be. But at the same time, I suppose we've been going through something fairly unprecedented recently, too.
I would also add, I think there's some path dependency on this particular cycle. Warehouse banks, as partners with their lenders, have observed them accumulate servicing, accumulate net worth. They've observed them go through a period of profitability that's giving them some good insight into their balance sheet management and their financial wherewithal. So I do think it's kind of on the heels of such a profitable period for lenders that kind of leading into this cycle gave them some more visibility and I think financial cushion as well.
Good answer. Well, I'm going to put a cap on this. Once again, thank you to Polly for sponsoring today's session. But it seems like whether you're talking about compliance or interest rate volatility, bond market pricing, and so on, the wiser, more experienced folks are saying, you know what, it'll sort itself out. Don't go through knee-jerk reactions to headline news that might come across the internet. Take more of a wait and see, longer term approach to things. Does that sum it up?
Wise words. I couldn't agree more.
Well said.
I read that on a fortune cookie the other night. Okay. Well, guys, thank you very much for joining us, and thank you to Polly for sponsoring this, and thank you for folks who tuned in for the last 45 minutes to hear this. And we'll be back in a month, so it'll be March by then. Anyway, all right, take care, guys.